Well, thank you guys. Sorry about the brief delay. We were running video equipment in here. It was all very exciting. Anyway, thanks for joining. I'm Mark Lamonica. I look after the individual investor team from Morningstar here in Australia. Today, we're going to talk about funds, ETFs, and LICs, which hopefully should be interesting. So first, a couple of housekeeping items. That's Will in the back, running by. There he is, waving. See, he waves. Emily's sitting in here too. She refuses to wave. First couple of housekeeping items. Anything you hear today is general advice. I don't know anything about you. I can't offer personal advice. If you're over in New Zealand, get a copy of our FAP from our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice, but would love to ask questions. So I'll certainly go through the basics and some different things to think about when trying to decide between those different investment vehicles. But questions are great, makes it more interesting for me and hopefully everyone else, because there are other people that probably have the same question. So yeah, follow us on Instagram, listen to the podcast. Remember our conference, anyone who's interested in getting on the wait list for our conference for the cheapest tickets, get on that now, and then we'll open up the tickets, I think in 2 weeks. But let's get into funds, ETFs, and LICs. Okay, a little context. So we are, at this point, of course, talking about what investments you should pick. But something I always do like to reiterate is that while that is the first step that most people take, is all of a sudden diving into what's the greatest product to buy, really we need to start with you. So make sure that you build up an appropriate foundation before you're actually selecting the type of investments that are going into your portfolio. So that's understanding your goal, the return you need to get to your goal, and of course, asset allocation, which is really, really important. Then we get to the phase we are in now, which is picking investments. All right. So something else we like to say a lot is that there, of course, is no right answer, whether you should use an ETF or a fund or a LIC or anything else. There's just potentially a right answer for you based on your own circumstances. So that's what we're going to spend a lot of time talking about today. So what do we decide as in investors? Well, first of all, we've got this sort of instrument piece, which is what I referred to later, where we decide, are we going to invest in shares or bonds or lots of other different other different types of investments as well. An ETF or a fund has nothing to do with that. So I hear a lot of people saying, oh, I invest in ETFs. Well, no, you invest in what's held in the ETFs. Right? So that's why our first decision is around asset allocation. How do we select an asset allocation that will allow us to achieve our goals? And that is the mix between defensive assets like bonds and cash with growth assets like shares, listed property, infrastructure, etc. This is a very important decision. What we're going to talk about today is the strategy, whether you're going to take an active or passive strategy, and the vehicle that you'll buy, an ETF, a fund, or a LIC. So remember, this actual selection of what the vehicle is probably the last choice you're going to make as you're selecting different investments. First, you're saying, okay, I've done an asset allocation. So the first thing I need Aussie equity exposure, for example. Then we're going to evaluate which strategy would work best for that asset class, for Aussie equity. Then we look at your own personal circumstances and we decide if you should invest in a fund, ETF, or LIC. All right, a lot of people start here. Oh, I hear ETFs are great. Well, an ETF is simply a basket of securities. Nothing great about it. Could be some great things in it, but it's a basket of securities. All right, so let's go through a brief overview of these three different types of vehicles. An exchange-traded fund. So very simply, if you know what an ETF is, an exchange-traded fund tells you a lot of what it is. It is a fund that trades on an exchange. We'll talk about why that stuff matters, but a couple things that are important here. ETFs hold all sorts of different types of investments. So shares, bonds, cash ETFs even. It can be both active and passive. So I think there's this misnomer out there that ETFs are all passive. They're not all passive. There are active ETFs where somebody is going in there and actively selecting the investments that go in there. There is also a bunch of ETFs that may market themselves as passive, but they're not passive. They're following these obscure Frankenstein pieced together indexes. So very different. That's an ETF. So it trades on an exchange. And the reason why that's important is that trading on an exchange makes it potentially easier for you to access that. Because if you already have a brokerage account, which of course is where many people started out, because originally when ETFs came out, of course, people who were investors generally had a brokerage account where they were buying individual shares. Now that it trades on exchange, you can buy and sell them through your brokerage account. So we'll talk about sort of easy use later, but that's important. Funds. Same thing with funds. Funds can hold all sorts of different types of investments. Funds can be both active and passive. There are a lot of passive funds as well. So something to remember. So fund, of course, is pretty similar to an exchange traded fund, right? The difference being they trade off exchange. We'll talk about what that means in a second and what the implications are. Listed investment companies. Again, we'll start with the foundations. We'll talk about why this stuff matters. Listed investment companies are active. So there are not passive listed investment companies. So that is the one distinction between the other two that we looked at. A listed investment company trades on an exchange. So similar to ETFs, trades on an exchange. You buy and sell a listed investment company through your broker. So same broker where you would trade shares, same broker where you would trade ETFs. But it is incorporated as a company. We'll talk about why that matters, and that is very important. And it is close-ended. So the big difference, and we'll spend some time talking about this, between both funds and ETFs. Let's start with funds. We'll start with the basics of a fund. So what a fund does is a fund makes sure that it trades at the net asset value. So remember, these are baskets of securities. This is an important distinction. So they're baskets of securities, whether a person picks what that basket is or whether that basket is predetermined by an index, is a group of securities. So the fund and those securities, of course, are worth something, and we can tell what they're worth. In a very simple example, if they're just shares, we can tell what they're worth because we know what they're trading for. So that means we always know what that basket of securities is worth. A fund will trade at that net asset value, meaning that if I go buy a fund, I know that I'm paying exactly what those securities are that are held within that fund. And the way that this mechanism works for a fund is that they will just issue more fund shares if money is coming into the fund. They will reduce fund shares if money is going out. These are net inflows and outflows. And the way that this happens is that a fund, and this will influence how you buy and sell them, a fund is valued once a day. So what they'll do is they will wait till the end of the trading day. They will value that fund based on the value of the assets that are in it. So they will exactly equal. And then they will see over the course of that day, how many people said they wanted to invest in that fund versus how many people said they wanted to get their money back from the fund. And they'll come up with a net inflow or outflow, depending upon how those stack up. And then based on that, they'll create more fund shares at the net asset value. And that's the mechanism that is in place to make sure that a fund trades at its net asset value. I'm going to a little detail, and I'm going to keep doing that, but just to make sure that people understand how these work. An exchange traded fund is different. So when exchange traded funds, when ETFs were created, they were trying to solve for this problem, which I don't think is really a problem. But anyway, some people think it is, trying to solve for the problem that a fund could only be valued once a day. So that means as an investor, if I make a decision at 10:30 in the morning that I want to invest in a fund or sell that fund, I don't know the price that I'm getting. And the reason I don't know it is because you can only subscribe or redeem a fund once a day after the close of the markets. So depending upon how markets fluctuate during that day, means that price could be different. So I don't know exactly what it is, right? So for instance, I could go in and say, I want to invest $10,000 in this fund. I don't know exactly how many shares I'm going to get in the fund until they price those shares at the end of the day. So an exchange traded fund wanted to trade constantly over the day, right? So that it was easier for investors to buy and sell it. And so that I would pretty much know what price I was trading that ETF for, because I could go on and look it up just like a share. I could look up a quote, and while it may change a little bit while that order is getting executed, it was still pretty close. So the mechanism in place, and once again, I'm getting into the weeds a little bit about how this stuff works, but I think hopefully it will make sense, especially when we get to LICs. So the way that that works is they have basically market makers. At the end of the day, they call them authorized participants. And these are investment bank trading desks that throughout the day are keeping the price of the net assets in the ETF and the ETF value close together. And they're doing this by something called arbitrage. Now, arbitrage is a riskless profit. And the way that they do this is these authorized participants are allowed to exchange the basket of securities in that ETF for a unit of the ETF and vice versa. So if there's an anomaly in price, they can instantly make those trades and they will make a riskless profit, because they are, in a very simple example of an ETF that holds one share of Google, which I actually don't know what they're worth now. But anyway, let's say it owns one share of Google. They very simply can sit there and say, okay, one share of Google is $1,000. The ETF is trading for $1,010. All right, well, this is a good deal, right? So that's something that I can arbitrage and capture that $10. So ETFs do not necessarily trade right at their net asset value or the value of the assets in it. They trade pretty close. And there's this mechanism that's in place, this opportunity for arbitrage is what keeps it pretty close, right? And so what this is doing is it's creating, it's doing the same thing a fund is doing, but it's doing it instantaneously throughout the day. So it is creating more units or eliminating units based on this arbitrage that's happening to try to make sure that supply and demand and the net asset value don't move the price too far away from it, or supply and demand does not move the price of the ETF unit too far away from the net asset value. All right, so it is a little confusing. I'm hoping that helps. When we get to LICs, new shares are never issued and shares are never taken away. Now, there's some exceptions to that, but basically what that means is that in price of a LIC is not determined by what is held within it. It is determined by the supply and the demand for that LIC, just like a share that's trading any other company, a listed investment company, just like any other company is listed on an exchange. Supply and demand will drive changes in price. There's more buyers, price will go up. There's more sellers, the price will go down. But there is no mechanism to make sure that that LIC is in any way trading close to the price of the assets that are in it. So in that Google example, where I made up the price that the share was $1,000, in that Google example, it could own one share of Google, but the price of the LIC could be $500. So you could go buy something worth $1,000 for $500. Now, there's no real way for you to, of course, extract that value other than hoping that other people will notice this and it will go up. Conversely, the same thing could happen if there's really, really strong demand. Price of that LIC could be $1,500 holding $1,000 in Google. So hopefully going through the mechanics of that made sense a little bit. All right, so we're going to take a step back, and knowing those basic foundations, we're going to take a look at the decision-making steps that you would want to take as an investor. So the first decision you need to make, and remember, funds and ETFs can both be active and passive. LICs are active. The first decision you need to make is, are you an active investor or are you a passive investor? Passive, of course, means following an index. Active means someone or something, could be a computer, right, with quantitative investing, is deciding which securities to buy and sell. That's active. Passive, you are tracking an index. So an index being a group of securities that are representative of a market. Just like the S&P 500 index in the US is the 500 biggest shares in the US. So that represents large cap or big companies in the US. ASX 200 in Australia, 200 biggest companies in Australia. So that represents large companies in Australia. So that representative index is what you're tracking with a passive investment. So let's talk about why you would make that decision. And I think that a lot of people think that it is a one-off decision, that you're either an active investor or you're a passive investor. And that's not true. You can be an active and passive investor. You can make decisions based on asset classes and the characteristics of those asset classes to determine the best strategy. You can also try to, of course, from a portfolio perspective, you can try to direct your portfolio in a certain way because you're trying to achieve your goals. So let's talk about those. What are we going to look at between active and passive? All right, first category we want to look at is the efficiency of the market. Let me explain market efficiency. So the efficient market theory is something that really was sort of popularized in the 70s. And what the efficient market theory says is that markets are always fairly priced. So what that means is that while market levels, of course, are very volatile and fluctuate, they are in fact just reacting to new information and, of course, just repricing themselves. So at any point in time, a market is fairly valued, sufficiently priced. Now, I personally, and a lot of people, think that this is not true. And the reason why I don't think it's true, and most people actually don't think it's true, the reason is because this assumes a couple things. So this assumes that if every piece of data that comes out, the market instantaneously resets to a new fair value. It assumes a couple things. It assumes that the data is disseminated to everybody instantly. It assumes that, because all market participants, right? So everyone gets the data and everybody can interpret the data, right? So it means if I get a piece of data and Emily gets a piece of data, we have to instantaneously make a decision on what the impact of that data is on our valuation. And it also assumes, of course, that there is nothing else at play that would drive our decision making. There are no emotions involved. So, you know, a lot of people tend to think that no, emotions drive a lot of this. There is a lot of inefficiency. There's different skill sets in analyzing data. And a lot of it's just ignoring certain pieces of data that the market is not efficient. However, markets can be more or less efficient. So let's use a simple example here. S&P 500 is the most tracked index in the world. So the 500 biggest shares in the US. That means there are a ton of investors, both individual investors and professional investors, that are spending all of their time analyzing these 500 biggest companies. So that makes it less likely that there will be a large scale deviation between value and price. Just the sheer attention that is paid to this market, right? That means that when new information does come out about a very large company in the US, everyone knows it, right? And everybody's spending time analyzing it. And the more people that are doing it, the more likely that that market is more efficient. Then if I take some very obscure market, so I could take an emerging market, I'll just make something up. So like if it's the Malaysian share exchange, where less people are paying attention. And less people are paying attention, for one thing, because there's structural issues why people can't invest in Malaysia. It could be too small for a lot of professional investors, right? Like they have too much money to actually invest in some very small markets. And same thing could be with very small companies, right? If we're looking at micro cap or small cap shares. So less people pay attention. So when data comes out about a company that trades, a small company that trades on the Malaysian Stock Exchange, less people are going to get that data. Now, the fact that less people are paying attention to it and analyzing every little thing that happens means there could be larger differences between price and value. So that would be a less efficient market. So naturally, active investing works better in less efficient markets because there's less competition, because if you're really paying attention to that market, you have an opportunity to make more of a difference with your analysis, whereas everyone else could just be doing the same analysis. So active tends to work better in less efficient markets. And I don't think, and one of the ways that we can measure this is, of course, we can measure it after the fact and see how active investors did. So we do this at Morningstar. We have something that we put out called the Global Market Barometer, where we go and we look at each of these markets and we look at the percentage of active managers that outperform the index. The higher percentage, the less efficient the market can be. The higher percentage, the more likely we should use an active approach on that market. So particularly when you're looking at things like emerging market securities, some fixed interest, which is, difficult to invest in, difficult to track an index in, and smaller companies, small cap shares, for example, micro cap shares, tiny companies that less people pay attention to. Those are opportunities where active management can do better. Overall, passive does beat active. Does not mean there are not active managers out there that can beat their passive counterparts. One of the big reasons why active underperforms on an aggregate level passive is fees. So you charge a lot of fees for active compared to passive, right? Because you're paying all these people that are spending all their days looking for small cap Malaysian shares, and they make a lot of money. So of course there are more fees. A couple other things: how representative is the index? So does the index represent the opportunity set for securities out there? That's a really important one. So particularly when we look at bond markets, where the bond market is huge, right? The bond market's a lot bigger than the share market. So naturally, the indexes make up smaller parts of the bond market. So in that case, that index is less representative of the asset class we're trying to get exposure to. So once again, that gives advantages to active managers because they have all this giant sandbox to play in, even though the index is pretty small. How liquid are the assets? So liquidity just refers to the ease it is to trade something, right? Like how easy is it to go out and buy that? So if I went to you and said, go buy CBA, and then I said, go buy some small cap Malaysian company, it's a lot easier to buy CBA, right? It's going to be a more liquid asset class. So what that means is that for passive, we want very liquid markets. And the reason we want that is because when there's a change in the index, a passive fund or ETF has to instantly go out there and go and buy whatever that asset is. If 500 largest share in the US becomes the 500 first and something else goes in there, they're going to have to go out there and buy that. The more liquidity there is, the easier it is for them to do it, the less trading costs there'll be. But an active manager doesn't have to do anything that he or she doesn't want to, right? So they can sit there and slowly build a position over time. They can ignore something if it's too hard to access. They can make all sorts of decisions. So for passive, we're looking for very liquid markets. All right, so hopefully that helps a little bit with active passive. All right, let's go through, and I put equities on here just because we want something to kind of benchmark this against. So now let's look at what we do when we're selecting funds, ETFs, or LICs. Remember, we talked about the characteristics, the funds, ETFs, and LICs, but how does that actually play into your decision-making process? All right, so transaction costs. So generally, you're not paying a transaction cost on a fund. Now, there is a buy-sell spread on them, but no transaction costs. Where equities that you buy on an exchange through a broker, you generally have to pay for that. Now, there are some free brokers, but you're generally paying for that in some other way. And you're, of course, dealing buy-sell spreads. ETFs, they trade on exchange, they trade through a broker, so you have to pay brokerage for it, and you still have these buy-sell spreads. Same thing with LICs, right? All these three instruments that all equities, ETFs, LICs, all of them trade on exchanges, all of them trade through brokers, so you do have to pay for that. So management fee, of course, if you buy a share, there's no management fee. There's no ongoing fee. Generally, funds charge slightly more. So if we're looking at a passive fund, for an example, and a passive ETF, generally the fund would pay slightly more. And that's because you do need to have more staff working in a fund to deal with all these subscriptions and redemptions, operations staff. So all the stuff that happens at the end of the day, where the other things are, they're just trading on an exchange. LICs are generally slightly more because they're actively managed. And we'll talk more about LICs. So they're slightly less. ETFs, obviously. Valuation method. So as I said, at net asset value, at the value of the basket of securities. ETFs, we can have that potential deviation. We can have a huge discount or premium to net tangible assets, basically the same thing as net asset value. Trading flexibility, we'll go through and say why this is good or bad. Everything that trades on exchange, you have higher trading flexibility. You can trade all day when the exchange is open. Funds, of course, are very low. You have to wait until the market closes. Minimum investment, equities, you can buy fractional shares now. So yeah, not really a problem. Funds are higher. So generally they require higher minimum investments than ETFs or LICs. Behavioral risk. Behavioral risk is the risk that you do something stupid. So for equities, high, a lot of volatility and easy access, right? Same thing for ETFs and LICs. Now, funds, there's lower behavioral risk because you have less trading flexibility. And I always make some stupid example when I talk about this, but like, and I generally use drugs, not like I'm generally using drugs, but you know, you can think of it anything as you're trying to quit. If you're trying to go on a diet, you probably shouldn't fill your house with a bunch of terrible food, right? That's not going to make you eat anything, but certainly going to make it easier. So the ability to trade things all day increases this behavioral risk because it facilitates us making snap decisions. You hear something from a friend, you see something in the newspaper, you get scared because the market's down a lot. That process facilitates the ease to do that you can just like do that on your phone. That facilitates poor decision making. And just like having a house full of junk food facilitates poor eating. Doesn't mean you're going to necessarily do it, but it doesn't help. So behavioral risk, a real reason why funds are something that I think most investors, that the thing that everybody hates about funds, that they're difficult, you have to fill out this paperwork, takes a little while, a couple of days to get your money back. All the stuff that people say they hate about funds are the things that actually create a speed bump that could make us a little more thoughtful about the decision we're making. So how these other things play out? Well, transaction costs. So transaction costs on funds are lower. So it also depends upon what approach you're taking, right? So if you are somebody who's investing with every paycheck and you're paying brokerage and bid-ask spreads or buy-sell spreads with every single paycheck, well, that adds up over time. So that's something to think about. So with equities, ETFs, and LICs, obviously fees matter. This is something you should certainly look at, especially around LICs when we talk about them. So number one, when you're going out there and finding an active manager that's running a LIC, you hope that he or she makes good decisions that allow you to achieve your goals, whether that's beating the market or whatever way of achieving your goals. But you also have to worry about the supply and demand of people in this LIC, because it's all well and good that some LIC managers outperforming their index significantly. But if no one's going and buying that and selling at a 50% discount, that's not great, right? And it's those changes in those discounts and premiums that affect you, obviously. Trading flexibility, everyone says that makes ETFs and LICs and equities better, but just think about that. Remember the behavioral risk. And obviously, depending upon how much you're going to invest, that could also influence your decision for what instrument you would use. All right. So we're going to keep going. We're going to look at a couple of examples of things that you should consider when you are buying an ETF. So we're going to do a couple of examples of ETFs. And then we're going to look at LICs and do a bit of a case study on why people would want to buy LICs. Lucky says, Miss Start, can I replay the full talk? Yes, you can. So we will have a replay up in YouTube at least a couple days from now. The anonymous attendee, we'll pause for a couple questions if anyone has them. Anonymous attendee C, funds, is there any advantage or disadvantage of buying funds via the ASX M funds platform? Yeah, the advantage is that it's easier, right? So what the ASX did, knowing, of course, that people do not like filling out all the paperwork. And I will say this is a very uniquely Australian problem. So basically, if you want to invest in a fund, you either do it through a platform, and the platforms generally charge pretty high fees, and most of these platforms require a financial advisor who also charge pretty high fees, which, you know, is great because you do get personalized service, but not so great because some people just can't afford that. But yeah, you can either go through a fund financial advisor and through a platform, or you have to go directly through the fund company, which involves filling out a lot of paperwork. Now, this isn't necessarily true in other countries. The US, you just buy and sell funds through your broker. Still the same thing where you can't do it till the end of the day and everything else. So the ASX is trying to sort of bridge that gap by offering M funds. So an M fund is a fund that trades on an exchange. Go look at the fees, would be my advice. But anyway, thank you for the question. All right, so let's look under the hood, because the other thing that's really important and that I've been trying to stress, given everything that's going on a lot, is to try to find the right investment for you. So I'm going to take a couple looks. So what matters? People talk once again about ETFs, and you hear all this chatter about ETFs. So this is my favorite ETF. This is a terrible ETF. And none of those reasons generally look at what's actually in them. And so we can go and look at the characteristics of the securities. Remember, the ETF is just the basket, right? We care about what's in the basket. So you can go look at the characteristics of what's actually in there to help you figure out if it's a good investment. So I took this, VanEck, MSCI World, Australia, Quality ETF. Qual is the ticker symbol. Our analysts give it a silver rating. That's an old price. So I should have updated that, sorry. But what I wanted to do is look at some of the different factors you can look at. I'll go through a couple of examples. So one thing, of course, you can look at when you're trying to look at an ETF is how big are the companies that are held in the ETF? And where do they fall on the value to growth spectrum? So we have a style box that we apply to ETFs. You can see right here. That's the ETF. So this has very large companies and a bit of a growth tilt. So why do I care about that? Well, I care about that because large companies and small companies generally perform pretty differently. Larger the company, the less volatile, certainly a basket of those companies will be. Small cap stocks could go up a ton and go down a ton. Generally, you see less of that with larger companies. Then, of course, you want to look sort of value to growth based on sort of where we are and what you're comfortable with, right? So from a valuation perspective, these companies are trading at higher multiples than quote unquote value companies. We also have a factor profile at Morningstar and a bunch of different factors on here. So we talked about size, right? So these are very big. The companies held in this Qual ETF are very big. So that tends to dampen volatility, remove some of the business risk. There's big companies generally have more access to financing. They sell a wider range of products. They sell products across a wider geographical area. Liquidity, remember we talked about liquidity. How easy is it, particularly in a passive ETF, for a manager to go out there and access the shares that are in this index? Talked about volatility, right? So we've got volatility on the lower side, thanks to size. Quality. So quality is an interesting one. So quality, and this, of course, is a quality ETF. Quality refers to a couple different things: the financial conditions of the company, better financial condition, better quality. Looking at the dispersion of earnings. So the earnings for these companies bounce around a lot. or do they stay relatively steady, hopefully increasing? That, of course, higher quality can equal lower volatility. Momentum, we're just looking at price movements there. So momentum trading, momentum investing has been very popular because the results have been pretty decent since COVID, not so much right now. Yield, do these companies pay dividends? Generally, the companies that pay dividends are less volatile. You obviously have another source of returns there with dividends. And that makes sense, right? To be a company that pays dividends, you got to do a couple quaint things like make money. So companies that have cash flows make money. Yield can be an indicator. And then we talked about style, right, between growth and value. Of course, for a global ETF, we want to look at where they are invested. So what are the countries that they're invested in? And you can compare that to a benchmark. So here we see they are overexposed to the US, which may or may not be a good thing. Since the GFC, that's been a very good thing. This year, not as good of a thing. They can see sort of where they're allocating the money between different countries. Then you can look at sectors. So sectors, we group sectors into 3 different areas. So sector is just a group of companies that perform similar business activities. And we lump these sectors into cyclical. So cyclicality refers to the company, how much its earnings will follow the business cycle. So when the economy is doing really well, these type of companies tend to do well. Use an example, basic materials. Why? Well, basic materials are basically the ingredients in construction. So when the economy is doing well and people are building a lot, basic materials tend to do well because those commodities that go into building things go up in price. So that's cyclical. Sensitive, so there is still some sensitivity to the economy, just less in the business cycle, just less than cyclical. And then defensive. So defensive is simply companies that should generally perform fine in aggregate, industries, sectors that should perform fine in the aggregate, regardless of sort of how we're going from an economic standpoint. And so healthcare is a good example for this, is that most people tend to go buy drugs, pharmaceuticals, stop making drug references. Emily's getting uncomfortable. Tend to go stay on their medication if the economy is going well or really poorly, right? Where consumer cyclical, maybe they'll delay buying a car, but they're probably going to keep taking their diabetes medicine, right? So that's why these are defensive. All right. And of course, you can look at valuation measures. So these are all off of Morningstar Investor. So get an understanding of where the valuation measures are compared to indexes. So this makes sense, right? The price to earnings ratio, the price to book ratio, price to sales, price to cash flow are all higher than the index. But that makes sense because when we went back and we looked at this, it has a growth tilt. So remember, growth are companies that trade at higher valuation levels. Everyone thinks that growth companies are companies that grow faster. They're not. They're companies that trade at higher valuation levels, which generally 99.9% of the time corresponds with companies that have better prospects in the future. But still, remember, they are 2 different things. You can look at dividend yield. Of course, there's all sorts of different things that you can look at, and certainly growth rates down there. And you can see that, of course, these are justified, right? The index, we're showing some negative growth. Here, we're very positive. That's why we're paying more for it. And then, of course, looking at Morningstar metrics, how many of the companies are wide moat. So remember, this is a quality index, and this makes sense, right? 64% is a wide moat share. So a company with a sustainable competitive advantage compared to a lower index level. All right. So I do want to spend a second on LICs because I think people have lots of questions on LICs. All right. So there's sort of a bull case for LICs and a bear case for LICs. So remember, a LIC is a licensed investment corporation. So what does that mean? It means that it is just like any other company. It's actually a company. It is not an investment vehicle that is a pass-through entity. So when this matters is when we start talking about earnings, start talking about income. So an ETF and a fund has to pass through, because if they're set up in a trust structure, they have to pass through any income that the companies in there earn. They also have to pass through capital gains. So if they are selling companies, because you have to pay those taxes, right? So if they are selling companies that have appreciated in value, they're going to pass those taxes through to you. And they have to do it legally. So you can get wildly varying rates of distributions. Now, distributions that you get from an ETF, for example, are not just income, also capital gains. So when markets are doing very well, and there is an ETF that's rebalancing frequently, buying and selling things, you could get a big tax bill, but you'll get it through that distribution. So I think a lot of people sit there and look at the distributions they're getting paid and say, oh, this is great, like the dividends are going up. Not necessarily, right? Could just be passing through capital gains to you. LICs don't have to do that. So LICs get to make a decision of when they will decide to pass through any capital gains and dividends that they make. Just like a company doesn't have to pay you a dividend, they can choose when they want to pay you a dividend. They could do a special dividend if they wanted, for example. It's like a company can do that, so can a LIC. And so the advantage of this, and the reason why a lot of retirees like LICs or income investors like LICs, is because, of course, the manager knows this, and what they try to do is smooth out those fluctuations in income that comes out of this and distributions that come out of a LIC versus an ETF who has to distribute everything. And the example we use is we go back and we look at 2020. So you remember 2020 with COVID, the initial reaction for a lot of companies was, okay, we don't know what's happening with the economy. We have to get through any sort of shutdown. We need to conserve cash. So a lot of companies cut their dividends. A lot of companies or suspended their dividends or eliminated them altogether. And you saw that, right? So if we sit there and we look at, and these are all mainstream Aussie ETFs, we can see the calendar year 2019 dividends, remember these are distributions, they could include capital gain, are much higher, like huge amounts over what they were in 2020 as those companies started conserving cash. So if you are investing for income and you're living off of that income, this is not a great situation for you, right? So not a great situation. However, if we go and we look at some sort of big and well-known LICs in Australia, and we look at 2019, 2020, we can see the changes were much smaller. In some cases, that income generated actually went up. Why? Because they can build out those reserves. So basically, those LICs can reserve dividends from past years and then pay those out as distributions at a time of their choosing. So as we said, this corporate structure that they have gives another dimension to active management. So none of this matters for a fund or an ETF, an actively managed ETF. Someone's just assigned to buy and sell stuff based on if they think it'll be a good investment. But now the manager can also sit there and decide when to distribute things. So that's the bull case. That's why people like them. All right, where they not like them? Well, the fees. There can be a lot more fees on LICs. And there can be performance fees on LICs. So basically, a performance fee says that if you exceed a benchmark, they get to keep part of it. Now, Wilson Asset Management, which is one of the largest LIC providers in Australia, has a particular, oh no. Oh, geez. Look what we did, Emily. Emily's very embarrassed by me. In that case, there is performance fees that is calculated on current year performance. So Wilson Asset Management is one of the biggest proponents of LICs. So what does this little thing mean? Well, what it basically means is that every year they get to start over and take a performance fee if they outperform. Whereas most companies will say, well, this isn't really fair, right? So if I have 4 down years and then 1 good year, I shouldn't really take a performance fee because I've underperformed the market in aggregate. and they'll go back and look 5 years. Wilson does it for 1 year. So they get a fresh start every year, right? They could lose 50% of your money the year before and then beat the market by 1%, and they will take a performance fee when you are still 49% behind. Yeah, the results of what's going on in these things are often rather opaque, and they can trade at a premium. They can trade at a premium for what the assets are worth. They can also trade at a big discount. All right. So we did it. I was going to do a little rant about ETFs, but we will save that for another time. So basically, I was just going to talk about some of the problems with some of these thematic ETFs, but I think people have heard that enough that I'm not a big fan. So yeah, send through other questions. So Ronald has a question saying, why were the factors so strong? Is the liquidity so low on the Van Eck graph? So let's go back to that. Let's make sure I know what we're asking here. We're looking at the first one, right? So basically, Ronald's looking at the other factors, and he's saying strong. Now, these can be good and bad things, depending upon where they are. From a liquidity standpoint, I don't have a huge answer other than sort of momentum and things that are traded a ton and have a lot of price momentum. And liquidity can be synonymous, right? The higher the momentum, the higher the liquidity. Lots and lots of people are trading that every day. So I think it's really just the fact that, a lot of the sort of traders and potentially a lot of the people and the things that people were trading since the COVID crash in March of 2020 are probably ignoring all these quality companies. So yeah, that would be my best guess. All right, Emily, well, not being offended by my comments, has put a link to our conference in. So you can sign up for a wait list. If you go into the chat, put it on the wait list. We'll offer you our cheapest ticket. The conference is October 13th in Sydney at the ICC. It's also available for people who would like to watch at home, either not in Sydney or just don't want to come meet the two of us, Emily. Emily's very offended. She's excited for her first conference. She's actually going to Europe with her sister, and she planned the trip around the conference. So she's flying back for it, then going back to Europe. But that's how committed Emily is. All right, so we've got a question from Johnny saying, missed the first 25 minutes. Are these sessions being recorded and made available for later? They are. So they're on our YouTube account, so Morningstar Australia YouTube. So let me see if I can figure this out. All right, so this is our account, Morningstar Australia. So there they are. So that's the one we did last Tuesday. So they are all available on there. So just go to our YouTube account. So it generally takes us a day or two to get them up there. Like we still don't have the one up from Thursday, but Will's going to work on that today, and then we will get those up. All right, we did it. Normally, I have lots more questions about ETFs. Oh, and Emily put a link in there as well. All right. Well, anyway, thank you guys very much. If you have any questions, feel free to shoot through an email. And yeah, appreciate you joining. And we'll be back on Thursday to talk about something else.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited, without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.